So
Well, good afternoon. It is Friday, the 19th of April. I'm Bill Roller. I'm here with Michael Elerath, fellow advisor at Beacon Rock Wealth Advisors, and Michael Harding, realtor with Keller Williams here in Vancouver, Washington, to talk about finance and real estate. Two great tastes that go great together, kind of like peanut butter and chocolate, kind of like Reese's peanut butter cups, which are always my favorite. So it's been an interesting week in the markets. Let's see, it was basically a very flat week. For the Dow, it was only up 1.28 points, which hardly ever happens. But that was offset by the Nasdaq, down 5.52% for the week. The S&P 500 off 3.05%. Part of that was due to the 30-year Treasury being up 10.9 basis points to an annual yield of 4.711. And of course, the big news this week was our old friends, the semiconductors that everybody used to love, uh, came in for a lot of hate this week, down 9.23% on the SOX, the Philadelphia Semiconductor Index. Part of that was the former high flyers, NVIDIA off almost 10%, SMCI off more than 22%. Uh, Concerns about valuations and sales going forward. So it was been a great week to build cash, which is what I've been doing. So who wants to go first? Don't all rush at once.
I can yield to Mike if he wants.
Sure, I can go. All right. So the last couple sessions we've discussed inflation and economic activity at the macro level. Interestingly, the forecast for gross domestic product show increases expected to be reported for March and another increase for April. And the core PCE price index is also going up a little bit for each month, kind of in a tandem response. In addition to that, consumer spending is going up a little bit, also in tandem to that response. Private investment will be increasing fairly significantly according to expectations. And the federal funds upper bound rate is projected to go from 4.5% in February, 4.8% in March, to 5% in April. So in spite of the Fed's expectations that inflation would be cooling, it is not coming to more fruition now. Although, of course, when we look back, we know it cooled from higher rates a year ago. So the economists that were surveyed to discuss, give responses to what's going to happen with the benchmark interest rate of the Federal Reserve, which is currently at 5.5%, expect that by the end of 2025, so that's a year and 2/3, that it will only fall from the current 5.5% to 4%. And in the last month, that expectation increased 0.5%. So there's still a lot of slogging to do to get the core inflation rates down.
So, Mike,
Although,
is that saying that the Fed is going to have to raise rates?
no, they're still expecting to be a cut or two cuts this year. And in relation to that, there is only a 30% expectation for the odds of having a recession in the next 12 months. So, no, Bill, no raise, a probable cut. Employment's expected to stay steady. Inflation expected to stay fairly steady. And the long term, when it comes to these rate cuts, when we were thinking there would be cuts this year, when we started the year, now we're over a year and a half out for the expectation that the Fed funds rate would decrease to below 4%. And the interesting thing is that consumer spending has increased and is expected to stay strong. So that would forebode a recession, since consumer spending is the largest part of economic activity, gross domestic product. So, things are okay. Of course, we know the markets don't like wars. They don't like restriction on shipping of oil. So, we're going to have to wait and see how that plays out in the economy. But it looks like, it's just going to be a steady economy. So that's a pretty good thing. And in spite of what's happened with prices this week in the technology stocks, I think we should go back and think about how much they've increased in the last 6 months. So this pullback of 10% still leaves those that type of an index on a positive ground by quite a bit, still probably outgaining the rest of the sectors. Do you have any numbers on that, Bill?
Well, there was a pretty good discussion at IBD Live this morning, talking about where when a retracement kind of becomes a concern, and they basically said we're kind of right there at a 50% retracement from the low that was hit last October, November timeframe. So, things kind of need to improve, by next week, or chances are they're going to continue on down. I'm looking at the SPYs right here. They're at 495. They hit a high of 524, as you can tell, and they hit a low of about 417. So it's kind of bracketing that. On the NASDAQ, the Qs, they hit a low of about 350 and a high of 449, and so they're at right around 413. So it's kind of like right there for the indexes. So things can change relatively quickly, of course, in the market. But Powell has been pretty slow now to react to the stock market. He's been blamed in the past of the Powell put and all that kind of thing. So, the cavalry may not arrive in the form of lower rates or the Fed increasing liquidity. I did read something that said basically that we tend to think of financial conditions as being rather tight right now, but in fact they're very loose. Looking at things like loan originations and banks and lending criteria and that kind of thing. So, but don't forget that in some ways the stock market is a forward-looking indicator. It's a leading indicator, so it may be seeing problems out there that nobody else is at this point, or at least not seeing them yet. But Michael Harding, what's going on in real estate? I got your stuff ready to go if you want me to share it.
Yes, if you would, could we start with the spreadsheet?
The usual spreadsheet. Yes,
Uh-huh.
we have technology. Share
We have
screen.
the technology. Yes, we do.
We have
I
it here.
am looking for something online real quick because I don't remember what source from. Anyways, the report that the Portland area is losing a large percentage of people because of affordability of the use uh,
Um, you're
measure that drugs that things.
Michael, you're
So
breaking up a little bit there.
We have an yeah, we have an audio difficulty.
Yeah, that sounds like it.
well, I can you see me?
I think we lost him. I think we froze him.
Poor guy.
He's totally frozen.
That was
Well,
quick.
here's his.
Shall we look at the spreadsheet and see if we
Yeah,
can
let's look at
discuss
the.
it?
Let's got the spreadsheet here.
See if I can get it up here on my screen.
Not a huge amount of difference
How
there.
about now, guys?
Yeah,
Can you hear me
better.
now?
Yeah, you're back.
Okay, I'll talk fast. Um, for the spreadsheet, everything looked good. There was one that I kicked out because it took everything way too high, and I have that in the notes. There was one that sold for $4 million, and if we included that one, then it would have skewed the numbers a great deal, and so I um I excluded it. Um, Portland's losing middle class homeowners to Vancouver and Clark County.
Shocking.
What else is there? Mortgage applications are up nationally from according to the National Association of Realtors. And then oh shucks, I don't remember what else I was going to tell you, but it was insightful, but I can't remember because I was thrown off because of the technology issues. But anyways, the market is looking pretty good. And if we can go to those the screenshots that I sent, Bill, please.
Yeah, which one would you like first?
Whichever one is closest to you.
I've got all four of them ready to go. Pick the
Yep.
one you want. Inventory
The
in
first
months.
one.
Okay, inventory in months.
Yep. Well, that just shows the inventory as it stands. And in case you forgot or you haven't heard, 0 to 4.9 is a seller's market. 5 to 7 is a balanced market, and anything 7.1 and above is a buyer's market. So we're still pretty well cemented into a seller's market, not as much as we were in 2022 when we had barely any inventory on. And again, a reminder, if nothing else comes on the market, we will have exhausted all the inventory at 2.1 months. That's what those figures represents. The next one, please.
The sale price percent change.
Yeah, this just gives you a small snapshot of how the prices changed over the last 12 months. So we had very, very marginal change. Um, we're up 4,000, 5,000, or 3,500. So it's better than to go up a little bit than go down a little bit. So next one, please.
Uh, Residential trends or residential
Yep,
highlights.
the trends.
Trends it is. The trend is your friend.
A trend is your friend. And so this just again it shows the top spaces March compared to February, and it just shows the direction of the market. And then the one on the second half of the screen is the March 2024 compared to 2023. And so again, everything is looking really healthy. There's no red flags, no warning signs or anything like that. And so the last one, please.
By process of elimination, the residential highlights now on your
Yes.
screen for your viewing pleasure.
Yep. Great. And this is all that other stuff um, in one convenient bite-sized package. This just shows that it gives you a greater detail of the numbers, how it affects. I'm sorry, not how it affects, but the changes over the months. So like I've constantly said, the market is in good health, subject to change based upon employment and economic data that's being uh, dealt with on a daily basis by the feds and folks in the local community. So before I break up again, I'm gonna toss it back to you guys.
Stop the share there. Thank you very much, Michael. Well, that's good. That's kind of short and sweet on that. Michael Elerath, you got anything you want to add on that?
No, not today.
Okay. Well, I see that according to Zoom, Michael Harding's bandwidth is low, even though he's usually a very high bandwidth kind of guy.
Hmm.
So,
I usually am.
so on that happy note, we will stop recording.